A margin account is similar to other account types. You can buy, sell, and hold securities, but it provides one unique quality: leverage. To understand how margin works, let's start with other account types such as a TFSA or cash account. In those, every time you want to purchase an investment, you must have enough cash in your account to cover it. If you don't have the cash, you have two choices: sell an investment in your account or transfer in more cash. Another way of looking at it is your investments are locked up. No matter how valuable they are, you can't tap into that value unless you sell. Margin works differently. The investments you own are collateral, which you can borrow against in order to buy more securities. It's like borrowing from yourself. There's another financial product that operates in a similar way: the home equity line of credit, or HELOC for short. This is where you use your house as collateral, and you get a credit line based on the market value of your home. If your house is evaluated at $500,000, you may get a HELOC of $325,000. And just as with margin, the value of your asset is unlocked. Now that we covered the fundamentals, let's get into some important details. With margin, the loan you receive is based on the investments you have and the ones you want to buy. Each investment has a risk profile. A higher risk profile means a lower loan amount is available. Most eligible stocks that trade above $5 on a major exchange will qualify for a 70% loan value, or 30% margin. What does that mean? If you want to purchase $5,000 worth of stock with a 30% margin rate, you need to put up at least $1,500. The remaining $3,500 is borrowed. This borrowed amount is called the loan value. That 30% capital is called the margin requirement. The margin requirement plus loan value will always equal 100%. Another important detail to keep in mind is interest. Just as with a HELOC, if you don't borrow money, no interest is charged. If you do borrow money, interest is charged on the amount you borrow. Unlike a HELOC, the market value of your investments can change, either up or down. As the value of your investments change, so too does the loan you receive from your investments. Unlocking the value of your assets is a powerful tool. But remember, just as margin can amplify your performance for gains, it can also amplify your losses. Remember our $5,000 stock with a margin requirement of 30%? In that scenario, you needed $1,500 for a $5,000 purchase. If your investment goes up to $5,500, the return would be 33.33% minus interest owed. On the other hand, if you put up the full $5,000, the return would be 10%. Now imagine your $5,000 stock decreased in value. The same amplification rule would apply to losses. If your investment drops to $4,500, your $1,500 investment would diminish by 33.33% in addition to the interest owed. If you had put up the full $5,000, the loss would be 10%. It's important to understand the risks of margin as well as the potential. Have any more questions about margin? Speak with an investment representative or check out more educational resources.